When a trader thinks about risk, they may primarily look at the information available on their charts. Therefore, they'll evaluate the price, volatility, support and resistance levels, and drawdowns as well. However, the biggest risks for a trading system often aren't visible on a chart, and markets don't usually damage a trading system through one dramatic event, but through structural change, which is harder to see. So, we're going to expand on these hidden risks right now. Now, here are the visible risks that every trader can see on a price chart. So if the price falls or volatility increases or drawdowns begin and losing trades accumulate, then these risks are easy to measure and are sometimes identified as the problem if a trading system is not performing as expected. However, individual positions may appear to be well diversified, but outside a price chart, we can introduce some hidden structural risks. So, firstly, if individual positions gradually start to become more correlated, then what suddenly looks like 10 independent trades can actually behave more like one individual trade. As the portfolio exposure starts to become more concentrated, individual trade risk starts to combine together and it begins to create more portfolio risk than originally intended. As the markets evolve continuously, trends start to become shorter, and this also relates to changes in volatility or liquidity, and even the relationship between assets. So none of these appear as warnings on a chart, but changes in the environment can actually mean that the trading system is operating in different conditions. Deteriorating expectancy. Now, this relates to the original assumptions supporting positive expectancy starting to weaken gradually outside the price chart that you can see. And this links to one of the most important risks of all, which is that every trading system depends on assumptions about the behaviour, markets, and relationships. So when these assumptions begin to change, then the trading system may also need to change to accommodate them. So let's summarize this now in a little bit more detail. So none of these structural risks are immediately obvious from a price chart, and they quietly influence a trading system from behind the scenes. The chart tends to show the symptoms, whereas structural analysis attempts to understand the cause, because the most dangerous risks are sometimes the ones that you can't see, and therefore you don't routinely measure for them, such as the correlation or the portfolio structure, even the market behaviour or system assumptions, because by the time they appear on the chart, then performance may have already started to deteriorate. So it's important to understand the difference between what happened and why it happened. And this is the first step towards building a more robust trading system. Therefore, if you'd like to have a deeper look into structural analysis or trading system diagnostics, then I provide additional information in the description below. Thanks for watching today, and I'll see you in the next video.